Hi, everybody. Jim Kruzan here, and welcome to another end of the month review. This is for the month of July. Hopefully, everybody's enjoying their summer. And I know as a kid, once the 4th of July happens, it's like summer's in kind of full bluster. But we also know that back to school is happening soon. So hope you're enjoying the warm weather. Um, it's really interesting what's been happening here the last month or two. Actually, probably the last 3 or 4 months, because of the tariff talk and all the manipulation and front running that's been done. So a lot of the economic data has been really kind of lumpy. Some of it was a flurry of activity leading into tariff talk. Then there was a bit of a lull. And now companies are trying to kind of resize and refit as we have a little bit better clarity on what that looks like. We do these reviews every month and then a more extensive one every quarter because we are still watching the data and watching the data very closely. In our world, at the end of the day, the data ultimately matters. And we still feel that there could be two outcomes here. One is a recession that will happen and happen slowly as they typically do, and will come as a big surprise, as is typically the case. Or we might get this proverbial soft landing where the market really starts to, or the economy, I should say, starts to show signs of real improvement. Well, we haven't really seen that yet, nor have we seen the market fall off a cliff. So we're still in that kind of wait and watch and trying to be somewhat defensive and somewhat protective for obvious reasons. Also, we felt that at some point, the markets, regardless, would start to broaden out, and other aspects of the economy, other segments of the market, may very well start to outperform. Here we are now halfway through the year, a little bit beyond halfway. And we're beginning to see, at least reviewing year to date, that there are other segments that are starting to perform beyond just simply Mag 7. Maybe not so much in the month of July, but certainly year to date. So let's kind of start with some of the economic data. So you're looking at kind of the stuff we look at regularly. One of the big pieces of data that we look at regularly and have for many, many months now is the LEI, the leading economic index. It's an index built on 10 key economic components, and it's had an incredibly strong track record as to predicting what lies ahead for the economy. And it is quite predictive, and there have been very, very few periods of time with bad data. The one real knock and the negative with respect to this is it doesn't do a really good job of pinpointing the exact date, but it certainly gives you an idea as to, hey, you might want to be cautious here. And once again, for the month of June, that was reported out just 2 weeks ago, July 21st, that the LEI dropped again for the month of June, dropped another 0.3%. So you can see by the blue line, especially the far right-hand side, this has been somewhat precipitous. We've seen this drop now for 30 plus months. And for many of us, it's kind of like, all right, when are we going to see a recession? Well, nobody knows for certain. But we've had periods of time like this before where we've sat and waited and waited and waited. The financial crisis, the Great Recession was certainly one where the data turned bad as far back as '05, and yet bad lending standards, markets continue to go higher, real estate continued its speculative trend for better part of 3 years. And then everything came to an abrupt end toward the fall of '08. And by early '09, the markets were down 58%. That's the concern that we have. If you look at some of the other data, because the other problem with the LEI is it's sort of like looking at an iceberg floating around in some cold bay somewhere, doesn't move a whole lot. But the real importance is kind of below the surface. So there's a lot of other data that circulates that shows trends. And again, we're looking for anything that we can glean as a positive, that things are effectively improving. And other than the stock market values, it's really hard to claim that. We talked about the leading economic index. If you look at the third from the top, credit card delinquencies, by the way, sometime I think it's next week, this gets updated for the last quarter. We'll see if that's also increased, but it has been. Credit card delinquencies, those over 90 days late, are now 12.3%. That's up a full percent from just the quarter before. And we think now, because of student debt requirements and the fact that payments and interest and bad debt reporting are all now in full swing, this puts a lot more pressure on credit card payments. Remember, the last 4, almost 5 years, most people with student debt haven't had to make payments. So that money's been reallocated elsewhere. Consumer credit card usage is falling, and that's also a leading indicator. And it's probably not because of austerity, but really maybe the avenues and opportunities of credit are being reduced for some sector of consumers. That's important because 70% of our economy is consumer based. And then the other slow unwind that certainly will have its effect is commercial mortgage-backed securities. We've talked about this before. This is mortgages on office buildings. Unlike the mortgage on your home, which can be a 30-year proposition, most mortgages on buildings are 5 years. So if we go back in time and say, gee, 5 years ago, what was happening? Well, interest rates were still really, really low. We were at the beginning stage of COVID. Yet, while people were working from home, tenants were still required to make payments. So buildings were still fairly fully leased from the standpoint of cash flow. That quickly changed as some of these leases came due and tenants realized they don't quite need as much space. Today, the occupancy rate is well in excess of 30% across the country. It's vastly higher than that in large urban areas. Think of those old brick office buildings, 60-story monoliths. They're as much as 50% vacant. So delinquency rates are rising. And over the course of the next 2 years, we're going to see almost $2 trillion of these mortgages come due. And that becomes a problem because the rates are a lot higher today. But the big problem is they don't have collateral because the buildings are worth less than they were 5 years ago, because there's less cash flow, there's less tenants. And in many cases, we don't even have the cash flow or collateral needed to secure the loan. That becomes a regional and small bank problem because they're the guys who are holding a lot of these mortgages. So think of that as a spigot of liquidity starting to tighten, slow moving, but it's not an improvement. It's getting worse. It's not getting better. Manufacturing has been in a slump for quite some time. We've seen a lot of the national ISM numbers come out weak and have been in some form of contraction for months. The PMI index, the top one's been in contraction for 26 months. Every once in a while, there's a bright spot. Philly popped up in July. The Empire State, which is New York, popped up in July, first reading since February that was positive, all of which are still in contraction. But it was an improvement nonetheless. We'll see if that's a trend, or we'll see if some of that is a result of this whole tariff thing, hitting the brakes, hitting the gas. We'll see what happens with respect to that in the near term. Real estate, we're seeing existing home prices starting to drop, inventory starting to rise. And we're seeing a really sticky inflation number, not particularly high, but it's not where the Fed would like it to be, which puts some pressure on when they cut rates. We may very well see a rate cut, maybe as soon as September now, because the unemployment numbers are really starting to look weak. And that's usually the last shoe to drop before you see a weakening economy. I've been saying for quite some time, I don't believe the BLS numbers. That's the Bureau of Labor Statistics. They've always shown really robust growth in terms of new jobs. Whereas the ADP number, which is literally people who are being added to payrolls, real human beings, those numbers have been a bit weaker. Just Friday, there was a big miss with the BLS. But what was even more incredulous is a huge revision of for both May and June. So those 2 months where it looked like employment was really robust, not so much. We had, I think, 19,000 new jobs as opposed to 140 1 month and 14,000 new jobs versus 133. Big miss. So we'll see if that trend continues. We'll also see whether that was just a result of some front running with respect to tariffs. Beyond the economy, one of the other issues is valuations are really, really high. And when valuations are really high, there's not a lot of room for error. Think of it as operating without a moat or without any degree of insulation. And you'll see that, and we certainly saw how that played out earlier this year. When we finally got an idea what the tariffs were, the market was down 20% very quickly to the point where the S&P was down 15 for the full year. And then even on Friday, when the BLS numbers were revised down, the market sold off 1.5%. I'm not worried about 1.5%. I'm not really worried about 15. I'm more worried about 40, 50, which happens going into recessions, especially when valuations are really high. So that's why we're maintaining a defensive position. But this is the Buffett indicator. We've talked about this before. It's a real thumbnail, quick, folksy reference to whether we're in a bubble or not. It takes the total value of the US stock market, that's all publicly traded stocks, and they divide that by GDP. As of March, it was 200%, extremely high, rare earth kind of high. Historically, long term, that average is more like 88%. Total value of the stock market is a little bit less than GDP. And you'd expect that to be the case. When you buy a stock, you buy forward earnings, you buy future cash flow, you buy future productivity. And that's what the stock price is all about. GDP is actually the sum total of all goods, services produced and consumed within the US. It is our national productivity number. So how could the stock market, which is just a component of GDP, US government participates, as do non-public companies, my little firm, University of Michigan, healthcare systems, on, also contribute to GDP, but not the value of publicly traded stocks. So you'd expect that number to be a bit less. Well, today it's 2x. And that was as of March. If we look at the values as of July or here August, it's 205. And that's after the improvement in GDP, which happened as well. If we look at this as of July before the revisement, it was about 212. So that number is now as high as we've ever seen. And that's important because there's these historical trends and some significance. This is not the stock market. This is actually that valuation, that ratio, the blue line. And we can see this is through March. Actually, if we updated this for today, it would be at the highest point ever. And whenever we get kind of frothy, we get to 2 standard deviations removed from trend line. We get to these extreme valuations. At some point, this comes down and comes down hard. And when you see this big drop in the blue line, remember that stock value over GDP. And if GDP were to come down because of a slowdown or a recession, guess what? That ratio goes up. Mathematics. So this would denote a big drop in market. And we saw that in the late 60s after the blow up of the Nifty 50. We saw that in the year 2000 with the blow up of the .com stocks and those high valuations on certain retail names. We saw that coming out of COVID, where we had all the mime stocks and everybody was trading on Robinhood, et cetera. And then here recently, Meg 7 and otherwise, these valuations don't continue to go to the moon, at some point gravity kind of topples them over. So when you combine kind of cautionary economic information as well as high stock market valuations, it's certainly cautionary at best, not a time to get over your skis. To put some of that in perspective, when we look at market cap to GDP, like I said, we're way beyond historical trends, way beyond where we were at prior peaks. And if we look at the valuations, this was as of July, we're at 213. We're at 205 today. But you also include the publicly traded crypto market valuations versus GDP, or more like 225, 226. So we have extreme valuation. How does this play out in the markets? Well, for the month of July, the S&P was up about 2%. Now, it was skewed up a bit because the NASDAQ was up almost 4. Again, technology-based. Equally weight S&P, same names, just without the emphasis, was actually down. The Dow Jones was nearly flat. Large cap value, blue chip dividend paying stocks were flat. Gold was actually down. And a 60-40 balanced fund was either slightly up or slightly down, depending on what index you use. So why the skew? Well, it's our friends, the Mag 7 again. For the month of July, the S&P was up just over 2. Well, the Mag 7 alone contributed over 2 to the S&P. So we've got that skewing. But on a year-to-date basis, Mag 7 represents maybe 50% of the market returns, not 100% as they were in July. And you can see why, going back to the prior chart. If we look at a few categories, for example, things like international markets are up 16+%, quite a bit more than the broad-based market. Gold is up 20+%, quite a bit more than the broad-based market. The US dollar is up nearly as much as the S&P, maybe a little bit more, and much more so than the Dow or the equally weight. So there are other components of the market, this broadening out that we talked about, which helps stabilize the portfolio and allows us to kind of hedge out here a little bit, which is frankly what we've been doing. So that's kind of the wrap up for July. We'll see what August looks like. It's still kind of a seesaw, a little bit up, a little bit down. We'll report out at the end of the month, certainly. If there are any questions, by all means, reach out, let us know. And as always, thank you so very much. Enjoy the rest of your summer, and we'll talk to you at the end of the month. Take care.